A catastrophe in slow motion. That is the US economy, not just in housing, but it's also the global economy. Global housing even is seeing an epic crash coming. August was bad for home sellers, but it was also equally bad for many countries around the globe. And as we expected last week, the inflation numbers came back and they were much worse than what we were being sold. Today we're going to talk about the newest data that came from August, what's happening with inflation, and the fight that's in front of us as Jerome Powell pushes harder, driving us further into recession to get a handle on prices as the everything bubble rages on. We're also going to talk about Opendoor, the iBuyer flipping monster that has absolutely lost a ton of investor cash in the month of August. Investors there are jumping ship. The ones that are left are stuck at a $4 valuation per share. We're going to jump in exactly how bad it got and what all that means for housing near you as we head into the next month. At the outset, I want to tell you thanks for watching. Do something for me right now real quick. It's free. Hit the like button. And 90% of you have not subscribed. Hit the subscribe button to stay on top of the market changes, the macro view of real estate, and economic changes. First up today, last Thursday marks the last day that the Fed buys mortgage-backed securities. Save the date, folks. I didn't mention this in my opening, but this is a very critical piece of information. The Fed has been meddling with the mortgage market going back to 2008. They've been purchasing mortgage-backed securities, and the reason the Fed does this is it creates artificially low interest rates, and the outcome obviously inflates the housing market. Well, the Fed has been announcing for the past year that it was going to taper off, and it has been. That eventual taper ended last Thursday, and it remarks a very unique time in history that the Fed is finally backing away. They really want to focus on getting out of this asset class. Now, that is the interesting part that I've been reporting on, is that the Fed right now, over time since 2008, have accrued more and more and more MBS. Mortgage-backed securities are bundles of mortgages that the Fed has been collateralizing over time, and now it's $2.3 trillion that they're going to start feeding back into the system. As I mentioned last month, and maybe you didn't take me to heart, I told you interest rates were going to rise on the back of the Fed tightening in this particular area, and it's only going to get worse. I foresee the 30-year interest rate continuing to climb from this point, further adding pressure to an already dropping housing market. But you couple that with everything else that's going on with the Fed at the moment. As we saw last week, the core inflation numbers came out and they were twice as high as the market was expecting. Now, heading into this announcement, leaders of fund companies were on CNBC recently saying, "Oh, I can tell by the gas pump, everything is fine. The Fed's getting a handle on inflation. Don't worry, the markets are going to be fine." Then all of a sudden, the real news comes out is that Americans are still getting hammered on the cost of their gas, their home insurance, their medical insurance, and everything else in life. That it's truly not coming down. In fact, food got more expensive last month. Food is on a trajectory to grow by 11% annual this year. The idea that Jerome Powell is going to bring all this to a soft landing is out the window. Consumers are breaking under the strain of cost of paying for everything. A former Fed chair was being interviewed just the week prior saying Jerome Powell is going to get it under control. It will be recession, it will be pain, it will be unemployment, but he's going to push the interest rate even harder. We know what the next rate announcement is going to look like here in a few days. And as the Fed pushes up rates, it's going to close down supply of finance, it's going to hinder business expansion, it's going to do what it does. It drives things backwards. Unemployment will rise, recession will be furthered. Federal Express's earnings were off on Friday. The CEO was put in the firing squad, being interviewed on why his profits were down. He said, quote, "I'm very disappointed in the results that we just announced here. The headline really is a macro situation that we're facing. We at FedEx are a reflection of everyone else's business, especially the high value economy in the world." The FedEx CEO basically saying it plainly for all the viewers, we are in a worldwide recession. It couldn't be more clear when you have FedEx seeing their numbers come backwards. And it will get worse. And the pain that Powell has been announcing will happen. I watched billionaire Barry Sternlicht, CEO of Starwood Capital, come out and say that, quote, "the economy is breaking hard. And if the Fed keeps this up, they're going to have serious recession and people will lose their jobs. We've printed so much money. We created lockdowns. We caused the supply chain to stumble to a point where it has not regained its strength. At the same time, we have global leadership that are pushing all kinds of initiatives that don't help the situation." So, when you create situations where you're hindering the flow of fertilizer and you're, at the same time, we're in a proxy war with Russia where we're not on the front lines battling them, but we are sending them a ton of cash and resources. And through this process, that's money that is just being pushed out that we don't have at a time when we need it. And additionally, Joe Biden goes on 60 Minutes this past weekend and says, hey, you know what, China, if you take on Taiwan, you're gonna have to deal with us. So why not? Let's go fight another country, Joe Biden. And I have good confidence in him because, 3 times in the last week, he got lost on stage. He was giving a speech to the Hispanic caucus. I saw him spin around in circles, couldn't find his way off stage. He was giving a speech to cancer survivors. Same thing happened in the Detroit car show. Now, obviously, we all know how this works at the presidential level. He's guided and directed on pretty much everything he does. And the guy's days of actually creating and drafting law and calling the shots to a high degree are probably behind him. But at the same time, we have some real issues on the table. When you drift back in the housing market has some of the lowest inventory levels on record, okay? Track with me. You want to talk about a systemic problem in housing that will drive us into depression. Hear me on this. People that listen to this channel, a lot of times the comments are filled with people who are absolutely confused because I will say something and you would hear what I say and the logical economic outcome that would bear from the words I said don't make any sense to the outcome that I shared. And I'm saying to you, someone in the comments said, well, this guy's not exactly a Yale grad, is he? Because he said one thing and it should be this outcome, but he said the outcome was completely different. And I'd say, yeah, this is a very bizarre thing. And I'm sharing that with you on the precedence of what I'm about to share, because what I'm about to share should not have any relevance. It shouldn't happen, okay? So let me take you into the month of August. So in the month of August, seasonally adjusted new listings of homes for sale fell 8% from July to August to their lowest level since May of 2020, okay? We obviously know that's when the housing market was paralyzed by the onset of the COVID pandemic. Nobody was doing anything. Everybody was scared to breathe on their neighbor. Prices across the nation in that same period of time as we see record low levels of new listings hitting the market. No inventory, right? So what happens when there's no homes for sale? You're right. Prices are supposed to climb, at least stabilize. They fell. We had 1.3% loss of price, according to Redfin, in the month of August. Now, track with me on this. At the same time, in other news, U.S. rent prices are showing signs of cooling down. Yes, so all of you folks that love to attack me on the comment section at times, it's not a lot. It's actually usually 1 or 2. Explain to me how that makes sense. Let me just run down the marketplace with you. Sellers are not listing houses. We're a multi-year low. Homes sold, that means the amount of homes actually leaving the market. So the new listings are way down. The homes leaving the market are way down. Homes in active inventory that have price reductions is a record high going 4 years back. Median sales price is dropping or flat most markets throughout the country. The active listings are starting to fall again. And to clarify, when I say active listings, that means the active static amount of homes. There's not a lot of homes coming in, and there's not a lot. The pendings are dropping, the amount of homes that are going to contract are dropping, and the amount of homes sold are dropping. The funny thing is, believe it or not, even though there's so few homes hitting the market, for a minute, the amount of active supply would still climb a bit because it was just so slow moving, and a lot of homes that were under contract were canceled and came back to the market. The day on market time frame, age of inventory, still climbing. The interesting thing in all this is you would say to yourself, okay, what's going on in the housing market? If people aren't putting their homes on the market, people aren't buying them as much, because obviously the rate of sales is going way down, then people are choosing to do what more frequently? Rent, right? Okay, well then explain to me this headline. ABC News came out just a few days ago and said U.S. rents may be showing signs of cooling down. Asking rents fell to 7.1% in August, down from 8.4% in July. A combination of strong demand, low supply, and high inflation have kept the pressure on rental prices. But for the first time in 20 months, asking rental prices saw negative growth, 0.1% from July to August. So now remember, when you have a constant 2 or 3% plus every month, for the last series of months, several months in a row, probably almost 2 years, it's always up 2% every month. Rents are climbing, they're climbing. When it goes down to negative, it's almost like a 2% swing into the red, okay? Because it barely fell below zero. It was at 0.1%, so 1/10 of a point below zero. So the point is, how is the rental market not even struggling. How did it flatline? How did it go to a zero growth mode if there's no one buying homes, okay? So people aren't buying homes. And by the way, the housing market, when it went to 1.3, you gotta understand, when August was a 1.3% median price loss, that means we've been up. Most marketplaces are up to, some cases, 3% per month, month over month growth in price. When it goes from 2 and 3% down to negative 1.3 and there's actually a price drop, that's a 3% swing, 4% swing over the last year and a half. Obviously, you can't redline a car forever before the engine breaks. That is a normative movement. That's something that we expect to have happen. But how in the world do we get to where we are now? Listen, the point of all the data I just shared with you is this. There is a structural problem with housing demand. Structural problem. That means there's either layoffs, there's danger in incomes, something is off. The economy and the approaching buyers, the buyers that are coming into it, the activity is so off. I mean, it's not good, folks. And what I've been saying the whole time, okay, I've been saying this particular point for 3 months. Demand is way weak, and it's dangerously weak. And it so much so that if you really had motivated sellers and you picked the market up, which it hasn't happened yet, we've covered a lot of interesting stories to the effect that cause concern for that. Mounting layoffs, right? We just did the stories about how BlackRock came out and said, hey, I want to encourage all of you to get rid of these remote workers that have scattered themselves all around the country and draw them back into their home markets. You know, forcing possible sales at a time where you do not want to see sales hit the market. And when you look at the global economy is an interconnected economy that when you start to see this ripple effect go to where you have Vancouver and Toronto and you have Australia and you have China and you have so many other major countries where their housing markets are in serious trouble and they're in decline, just like the United States are. You know, we've only had two other times in history where you had two global housing catastrophes happen. The late 1920s and you had the mid 2000s going into late 2000, 2008, when you had multiple economies interconnected. It's bad. It's bad. You know, it's one thing if you have the US housing economy going into a struggle. Sometimes you can have some of these other countries where their population is doing a little bit better. They're coming in, they're buying up a lot of your real estate or supporting it so it doesn't suffer so much. But when you have a little bit of a distress scenario where you're starting to see people pushed into selling homes in duress, it's going to be bad. Listen to this. Robo Flipper Opendoor, the iBuyer, mega funded startup that's out there buying homes all over the US. They are the big one. Now, they're out there, and obviously I think most everybody at this point knows that Opendoor basically has, really online transaction where they, promote, hey, we'll make an offer on your home, and you go through the process. They make an offer, there's inspections that ensue, and their goal is to basically purchase the home from you, put that property back with some minor remod touches, and then for them to try and make a profit. Going back into the history of, not even recent, I'm talking about near history, Zillow just pulled out of this particular industry. They were flipping homes or buying homes from people as a service so that the person could sell, pick a date that they want to close. They don't have to show their house and all this kind of stuff. Zillow in November was the first major iBuyer to hit the brakes and exit the marketplace. Those were the guys acting on data in advance. Now, the market arguably did much better for the 4 months that followed, but they got out pretty close to the high. Now, Zillow, if you look in history as well, was losing a ton of money in their flipping. So even though the market was record gangbusters, those guys could not find a dollar to earn on their flipping. Listen to what happened to Opendoor last month. Independent research by Yipit Data did some research on their purchase and sale price. Very public information. It's not very hard to figure this out. Opendoor lost money on 42% of their transactions in August. Now listen to this. It was worse in markets such as Los Angeles. The company lost 55% of almost 6 out of 10 of their homes that sold in LA they lost money on. In Phoenix, 76% of the homes that sold in August they lost money on. A scholar out of Colorado, Mike DePret, said that he believes in September they're likely going to do worse in the marketplace. Now, for those unfamiliar, these guys, their stock is down to $4.06 as of September 16th. They're down their stock's down 72%. Obviously, anybody with a housing stock, including builders, including house flippers, including companies that house agents like Compass and Remax and all these guys, they're tied to housing. You're losing a lot of stock value right now. But it's interesting that Open Door is now getting hammered, and there's no sign that that's going to end. Now, I don't expect them to go far. And the reason why I say that is because you've stuck out the fight. You're now in the worst part of the housing, or you're entering what I think is going to be probably a considerably distant ride, because we have not seen the Fed really start to increase rates yet. They're moving them up, but they still got to keep moving this rate. When you have inflation, listing at almost 9%, your interest rate's not, Fed rate that is not high enough to actually defend this inflation. We know this, we've been saying it. We're all scratching our heads saying, how come Jerome Powell is acting so slowly? Prices are really, really messed up. And he's just taking, started with 0.25%, and then 0.5%, and then 0.75. It's like, were you waiting on the elections to be over? You're trying to protect those in election cycles. I mean, what is going on? Now you're going into a situation where that stuff has got to really hit the fan. The interesting thing is, as the economic woes get worse, you see some of the very, very big Wall Street guns lining up their cash for what's coming. Now, you can really see where smart money's going, right? Sophisticated cash. I told you the story, and you should click on the last video I did talking about how remote workers are being pulled back into their local markets. Goldman Sachs made headlines over Labor Day. That was a big one. It was interesting that Goldman Sachs came out and said, hey, you have to come back to work or we're going to lay you off. And then like a week later, they had an announcement of like how effective their layoff work is going, because they're actually going to have layoffs planned. It's like, you obviously can see that the whole goal of roping in the remote workers lays into the goal of actually getting rid of your workforce to some degree. But you also have BlackRock, as I mentioned, saying, hey, you know what? Let's draw everybody back to work. It's great for inflation. And I said how bad that would be for housing. Now, I'm not going to go back into that if you want to watch that, but understand this. If you go back in August and look at some of the headlines about BlackRock, BlackRock is putting together a massive amount of cash to go after housing deals next year. Does that validate what I'm saying? I didn't even know that at the time I was mentioning the fact that Larry Fink came out and was promoting the idea that we really should drive all these people back into the office from wherever they are, and how great that would be. But then to hear that 3 weeks earlier they're in the news because they're stacking $50 billion to go buy houses that I believe is in their minds going to be a pickup, a deal, a discount. By the way, $50 billion is a lot of money to buy houses. I mean, if they're just pouring that straight into residential, that's like 5% of the housing market. One buyer buys up 5% of the housing market on a typical year. Now, if they were to leverage that, which they have plenty of assets where they can get money much cheaper than the buying population can get. That's the unfair advantage that BlackRock has. So you go into next year, the market's getting even worse, and then BlackRock can go into Wall Street and get AAA bonds backed by the assets they already own, like their real estate collection they already have. They can get money essentially like for their house buying at like 2.5% to 3%. And you have John Q. Public having to get what, an 8.5% or 8% interest rate, 7% next year. And then BlackRock's going to come in against them. In reality, if they leverage the $50 billion they've raised, BlackRock could be buying 1 out of every 5 homes sold next year, assuming they go into the residential market. They obviously could put that money anywhere. That's it for now, folks. I wish I had better news. I purposefully am looking for good news. One of these days I will find it and I will bring it to your attention. But with that, I appreciate you watching. And if you have a chance, please hit that like button down below. It means a ton to me if you did. Subscribe to the channel to stick with us on this journey, and we'll talk to you real soon.